Now we are going to have a look at the risk versus reward characteristics of bonds and also relative to other asset classes. I suppose the first question to ask really is, what does the current risk reward look like within the bond market, would you say? I mean, I suppose obviously you have to be very discerning in terms of the types of securities you're moving into, but what are the trade-offs around that?
Sure. So I think many people would say right now that looking historically, bonds look expensive, and people are typically here talking about corporate bonds in particular, government bonds. So where government bonds, if you go back to the 1980s, might have yielded you for 10 years, something like 17%, today you'll get around a 2% return. In fact, it's slightly less than 2% today for investing for 10 years. So many people argue, well, if we have inflation of 2%, that surely government bonds aren't too attractive. And so they're forced into then increasing their risk profile, maybe investing in corporate bonds, and that includes bonds issued on the ORB for those higher returns. But right now, the main argument is that bonds look historically expensive.
Yeah, I'd certainly agree with that. We go back to those three sources of risk that we've talked about today: interest rate risk, credit risk, and liquidity risk. When you look at interest rate risk at this moment in time, you're being paid quite a derisory fee for lending to highly indebted governments for long periods of time. And Darren's touched on the sub 2% yields that you get on lending the UK government money for 10 years. Now, if inflation's over 2% over that time period, you've actually lost purchasing power. You'd have been better off spending your money today.
Absolutely, yeah.
We find ourselves in a Goldilocks economy, meaning that authorities will continue to allow us to tug along, particularly in developed market economies, whereby monetary conditions will remain attractive. You'll see the UK is still continuing its quantitative easing program to a large extent. European Union the same. The United States has drawn back, but Japan is still going strong. United States, many arguments, and probably a different subject, is they've cleared their credit card. It means they can do quantitative easing again, should they wish. But rates are remaining low at the moment. Inflation's low, so we're in a nice disinflationary recovery. And historically, bonds are expensive. But in a world where we're probably not going to see 2% call rates for some time, actually they'll probably continue to look a little bit more expensive going forward. As we discussed earlier, they do the high-quality indebted bonds like the UK gilts will provide your portfolio with some stress relief in times of stress from your equities. But at this point in time, actually, when you can get hardly anything in the bank, lending to decent corporates is one way of increasing your income yield.
I'd like to add a note of caution though, being the guy that won't actually get into the nightclub. It's basically that I think the way we look at it, we take a step back. As we just said, the reason that we've got excess liquidity in the markets is because of all the central governments or central banks' QE programs. And I think it's a phrase that's bandied around, not only in the press but in all the meetings we go to, is a fixed income bubble, and also the fact that we've seen the hunt for yield. And I'd have to caution investors to make sure that they're not going too far down the credit curve. And I think obviously companies are opportunistic when they issue their bonds. But again, we were talking about rating earlier. The lower down the curve you go, some companies won't be rated. The yield might appear attractive, but it's probably still historically low, even for a high yield. Which means that if there is a turnaround, I agree, it might not be this year, it might not be the year after that, as far as benchmark rates are concerned. If there is a flight from risk, a flight to quality, or if we reach escape velocity within the equity market, and you switch from bonds, and everyone switches from bonds into equities, then you will see that bubble burst, or at least some of the air will come out of that bubble, and credit spreads will probably start to widen to probably where they should be to add some value.
This goes back to the nightclub analogy we were having earlier on, obviously, where if you're in the front of the queue to get your money back, if you're at the secured high quality end, you're obviously taking less risk. Absolutely. You're going to get into the club. If you're right at the back, then you're taking more risk, maybe paying a little bit less, but you basically get the same experience. I just suppose on the, you're talking about these yield differentials. People often say with respect to the equity markets look expensive, but then they say, well, hang on a second, 10-year yields are 2%, so are they really expensive relative to these very expensive government bonds? Is there is there a kind of a hierarchy of overvaluation starting at the government security end and moving down?
Yeah, so I mean, I'm not sure that we would say that the equities are very overvalued. Clearly, they have done very well over the last 5 or 6 years, and things like PE ratios, one way of valuing equities, they seem to be up with events. In terms of looking at income yields, so dividend yields on equities and yield to maturities on bonds, you would have to say that comparing the two asset classes, equities do look better value. But then this goes back to really the suitability of different investments for different investors. So, for example, some people don't want the higher risk, the volatility that you get from equity investing, and they quite like the knowing I'm going to get a coupon paid every half year, and I'm going to get my £100 I put in at the start, I'm going to get it back at the end, and that's sufficient risk for some. So it's really trying to marry up risk rewards versus the risk appetite of the underlying investor.
Absolutely, and when you're looking at the risk of a bond investment, for example, a lot of investors will look at credit ratings, for example. Could you kind of just run over what you're looking for when you're considering the riskiness of a bond and what the credit rating can tell you about that?
Sure, it depends primarily what part of the risk budget you're in. So if one were to look at a bog standard balanced portfolio with a sort of 40% in fixed interest and then 60 in equities, and maybe some of that equity risk would be in alternatives. What you would tend to find depending on what sort of ratios you're using, if you are using some equity correlated elements, so higher risk, higher return, one would say that typically speaking over the last 10 years, having a 80-20, so 20% AAA rated bonds of 10 years or thereabouts, and then 80% risky stuff, mitigates that risk over a prolonged period of time, over a 36 months rolling period. So you would look for some element of AAA rated bonds depending on the environment at the time. But if you just went, well, I'll hold it for 10 years, that would be the sort of structure we might require. But Darren and Garrett, all of us, and Garrett have alluded to that actually depends on the current environment at the time. When we're in a very sanguine environment and the world is happy, and people are flooding in equities, you don't really want to own government bonds, and they're going to lose you money. You don't particularly want to own long-dated government bonds.
Let's go back to what we said earlier on, which is when you buy a bond, you're lending this organisation some money. Now, if you turned up at the bank and wanted a mortgage, for example, they would run a credit search on you, and they'd probably use someone like Experian to find out what your credit score is. The credit rating agencies are effectively doing the same job for you. You go to Moody's, S&P or Fitch, one of the three big rating agencies, they're effectively running a credit score on that organisation for you to give you some information about what's the probability that this organisation will or will not be able to repay that money. That's the best way to think about the rating agencies. But of course, even in a personal capacity, if you have an Experian credit score, there might be some things on that database which are historical or shouldn't be on the database at all. And that's where the opportunities come from people who are prepared to do their credit research. If you're prepared to roll your sleeves up, get down and dirty in the balance sheet and the income statements, etc., you will find opportunities where the rating on that company doesn't necessarily reflect the true risks of lending that organisation some money, and that's where you can add value as a fixed income bond fund manager.
Mm-hmm. However, credit ratings do, and so I agree with that, it's all about really doing your own analysis to find the good companies you like and maybe ones that are mispriced. But it's also important there's many investors that rely on credit ratings to invest, and that includes institutional investors. Some investors can only invest if a company has an investment grade, so a blue chip credit rating. And if they do, that typically means that a bond will do well, and it particularly means that the bond will be lower price from a coupon point of view, so the company can issue debt more cheaply. So it's one to watch.
Mm-hmm. Could you just kind of run over the distinction between what a investment grade bond and I suppose typically called junk, aren't they, if they're below investment grade? What is the threshold and what does that mean?
Sure. I mean, I think it's quite. I mean, it runs. Everyone knows what you say AAA. That's obviously the top of the board, and then you run down. You have AAA, AA, single A, and then triple B, double B, and single B are well below the investment grade. So investment grade stops at triple B minus, which is basically where you'll get a certain element of uncertainty with your coupon. Below investment grade, you have certainty to a certain extent. From the, you'll be advised by the rating agency that you will probably got a good chance of them paying their coupon, and their debt sustainability will allow you to get your money back at the maturity of the bond, dependent on the maturity of that bond, because rating agencies can change their outlook on a company. So the only downside of having a rating from a company's point of view, which they will make quite clear, and if they don't want the rating, is that if they do get downgraded, that will affect the pricing of their bond going forward, and it also probably will affect they have a knock-on effect to their existing bonds. So even if you go from investment grade and you get, even if it's just a downgrade of outlook from stable to negative, then it will have a knock-on effect to their pricing, which is one of the reasons why a lot of companies don't always want a rating. Anything below triple B minus is, as you say, the word junk is, I think, is more American, but high yield we prefer to call it, on the basis that from that level downwards, you then have it's quite obvious with the coupon. We're talking about risk reward. You are then taking on a lot more risk, but you will hopefully get rewarded, even though we are at historically low levels as far as coupons are concerned.
I think if we go back to some of the old parlance in bond markets, it would have been called speculative grade in the past. So there's a more speculative element. What I would say about investment grade versus high yield, though, is there's different ways in which you can get a junk or a speculative grade rating, and that either is the organisation you're lending that money to, their operations are far more volatile. That might be an oil company, for example, or alternatively, it can be because it's a stable organisation, but they've got lots and lots of debt. Their balance sheet would be what we call highly geared. So it's important, again, you do your research and you understand what the mechanism is, which has resulted in that organisation having a high yield, junk, or speculative grade rating.
That's a very important point, because also the lower down the matrix you go in terms of debt. I mean, if you have an unsecured rating, and there are secured rating, the secured rating might by definition be higher for a single company than it is if a subordinated rating will be lower, which means you'll get paid more, but the rating will be lower, reflecting the conversation we had earlier within ranking of getting your cash back in the case of liquidity.
And I think another thing we have to stress here is the rating agencies, when they give this letter rating, what it's actually telling you is the probability of default. It doesn't tell you what happens in the event of default. And as I said before, that's the far more important part when it comes to pricing credit.
Mm-hmm. Yeah. Investors should look out, and companies utilise ratings, because obviously the higher they're rated, the less coupons they typically have to pay. So we talked about governments only paying about 2% in coupons, i.e. your income, that's all you're going to earn. So it is that risk-reward functionality again. The lower you go down the credit spectrum, the higher one should expect to be rewarded for those decisions.
Mm-hmm. But because the credit rating agencies have historical data going back for many, many years, it is true to say that the investment grade, the higher rated bonds, have a lower rate of default historically than the ones in the high yield or speculative grade, or I think junk's unfair, but in those sectors they will have a high rate of return, but you get paid more money for investing in those bonds. So it goes back to our thing of risk reward.
But also I would highlight one thing again, being the voice of doom, is that default levels are basically at historic lows. I think they're running around 2%, slightly lower, because, and I think this is echoes the warning I made earlier, is that people are willing to lend to companies they probably wouldn't have lent to a few years ago because of the excess liquidity in the market. Mm-hmm. And it means these companies have actually not survived, it's probably a bit harsh, but let's say performed better on the basis that they're getting cash they probably wouldn't have been given a few years ago.
But that's probably a functionality of banks not lending as much as well. So they are going to the bond market.
I think so, but also I think it goes back to an earlier point that they forget banks will probably ask for security and make life a bit more difficult, where you can go to the bond market. Mm-hmm. It's a good and a bad thing from an investor's point of view. Yes, it gives them access to the bond market, and it gives you a chance to diversify your portfolio. It also gives these guys access to maybe investors that probably won't do their due diligence to the standard that maybe a professional investor would do.
Mm-hmm. But clearly one of the things we need to look out for as investors in bonds is the credit cycle. So we've talked about an economic cycle, we've talked about a market cycle, but the credit cycle. So there'll be parts of the cycle where companies are doing things that are very bond friendly. And there'll be other parts of the cycle where they're doing things that are very unbond friendly. And two examples of those might be that if they enter into M&A transactions, that they choose to finance it rather than through equity issuance, but through bond issuance, so they become more highly geared. They take on more debt. Or another thing they might choose to do is to do share buybacks, which is good for equity holders. If it's financed through debt, then it's less good for bond holders.
Okay. And I suppose another area we talked obviously about investment grade, speculative grade credits. There's also, of course, bonds which aren't rated at all. How would you approach those types of securities?
We would approach them in the same way we approach any bond, which is you have to do your credit research. And what you'll find with a non-rated bond is because, and Darren's alluded to this, there are certain types of institutional investors who are not able to buy non-rated bonds. What you find is it's a less liquid market. So we go back to those sources of risk that we talked about earlier, you end up getting more liquidity risk. Now, what we would say is if you're prepared to do your research, if you're prepared to get into those balance sheets, you can be rewarded for that because you're buying these less liquid bonds. If you hold them to maturity, you can capture that liquidity premium. But these non-rated bonds really do require that you do your own research on these before becoming involved.
Absolutely.
Remember, they have to pay for the rating as well. So if they are looking to raise capital, it might not be in their best interest. And indeed, you as an investor will say, well, actually, I'm really comfortable with the company, and I'd rather they not waste their money on a rating agency.
I suppose the obvious one, which we haven't talked about specifically here, is just interest rate risk. Is that the most important risk when you're investing in bonds?
For me, it isn't. The thing I care about the most, we've talked about corporate bonds, and the most important thing is, will I be paid my coupon and will I be paid my £100 back at the end? Interest rate risk matters, particularly when you're investing in longer dated bonds, because they have more interest rate risk. So for every 1% move in the yield curve, you're going to have a much greater move in its price. But that's nothing really compared to the potential to lose in all of your 100, which is unlikely. In bonds, you have a recovery, and we've talked about recovery rate. But no, I'm more concerned about credit risk.
Absolutely. So you would say, I mean, would you have a top? So you'd say credit risk number one, would you?
So for me, but I mean, the way that people are looking at things at the moment, they're saying, well, interest rates have never been so low. So what happens when Mark Carney and those others at the Monetary Policy Committee, when they raise interest rates, isn't this doom, isn't this terrible for bond markets? And the answer might be not necessarily, because it's not as easy to say when interest rates go up, bond prices go down. You have to try and work out what happens not just to interest rates, base interest rates as we call them, but also longer term interest rates, because these are the things that affect bond investments that have maturities of 10 years, 20 years, 100 years in some cases. So really you have to make predictions about what you think is going to happen to those longer term interest rates. So it is important, but it depends on what type of investor you are. Government bond investors are typically worried about interest rate risk. Corporate bond investors tend to be more concerned with credit risk.
I think it's also important to delve a little deeper into interest rate risk. There's two component parts. There's the shorter end fluctuations in interest rates themselves, but the longer you lend this organisation some money, the more potentially impacted you are by changes in inflation. So if you're lending an organisation for money for 10, 20, 100 years, you would be more concerned about inflation risk than you would about changes in short-term interest rates.
Okay, that's great. Wraps up our section on risks and rewards.